Hey everyone, me Kevin here. Do you know what December, January, May, and July all have in common? They're all months that I went on vacation and crashed the stock market, and guess where I am today? Well, folks, we just broke the 280 line on the QQQ. Crypto's absolutely getting rinsed, especially as DeFi platform Celsius decides to pause withdrawals. That's always a good sign. The 10-year Treasury just skyrocketed to 3.3%, which is going to smash real estate, especially those mortgage rates. I expect to see those skyrocket to the highest levels tomorrow. And stocks are dropping so hard, the tick index, which tracks positive, minus, and negatives, is negative 2,000, a level we haven't hit since September of 2011. So, what the heck is happening? Well, let's talk about it because there's a lot happening. We'll start with the Fed repricing. The Federal Reserve's meeting starts tomorrow. It ends Wednesday with a release on rates at 2 p.m. and a press conference at 2:30 p.m. We were expecting two 50 basis point hikes in June and July, and maybe a 25 basis point sort of pause in September. Well, now, the market is repricing all of this, and it explains exactly why the stock market is falling, because the higher terminal Fed funds rate we have, the more the market starts pricing in the risk that we're going to have an earnings recession, while at the same time, the Federal Reserve is tightening too much, potentially leading to the Federal Reserve's monetary policy crushing an economy that's already slowing to a halt. Now, the 250 basis point hikes and 125 basis point hike has already been repriced. Markets are now not pricing in, but potentially fearing a rug pull by the Federal Reserve, like a 100 BP hike to reduce inflation that's still spreading in broad-based categories everywhere, as based on our Friday's report. But markets are not pricing in a rug pull like 100 BP, but they're fearing that. Instead, though, we are pricing in now 175 basis points of hikes by September. That means the market now thinks we're going to get 275 basis point hikes, not 250 basis point hikes, followed by a 50 basis point hike, not a 25 basis point hike. We have a 32% chance, based on markets readings, that the first of these hikes will be on Wednesday, and a 50% chance that it happens by July, and then obviously the assumption is that somehow this combination will have happened to where we have 275 BP hikes, which will be the first time we'll have a 75 basis point hike since 1994, sometime by September. Now, the cool thing about 1994 is it's one of the times that the Federal Reserve was actually able to achieve a soft landing, but that is, they were able to raise rates without crashing the market, but don't bother looking what inflation was in the mid-90s when they actually had these hikes. There was very little. This increases the chances of those Fed policy mistakes. But beyond that, oh my gosh, we just had something happen again. That's also a very bad omen. But first, I just have to shout out our sponsor today, Public. If you want to get a free stock worth all the way up to $1,000, make sure you go to metkevin.com/public. That's metkevin.com/public, and you could use a brokerage that does not use payment for order flow, and it's a social community that you can follow me on at Meet Kevin. Go to metkevin.com/public and get up to $1,000 as long as you deposit some amount of money. All right, folks, let's talk about yields. So, we know that the Treasury yield's at about 3.3 right now. Terminal rates are being priced in at about 4%. The 5-year break-even rate fortunately just inflected down. We were down about 14% from its peak in March, and now we're down 16%. Thank goodness. We want to see those break-evens come down because, again, we don't want to see the market's expectations of inflation become unanchored because then we're just literally screwed. But guess what is back? The inversion of the yield curve. This morning at 4 a.m., the bond market plunged to a point where the 2-year Treasury yield had inverted with the 10-year once again. The last time we hit negative like this was on April 1st, which felt like a joke. It had inverted for 36 hours. This morning, we hit negative 1.814, and we inverted for about 18 minutes. That's much shorter, but we're also sitting on the edge of inverting again. We'll see what the Fed does and what it pushes yields to do. But anyway, the yield on the 2 years are therefore, at least were therefore this morning, higher than the 10 years, signaling that markets are trying to raise as much cash as possible, and they're doing so by dumping the 2-year bonds more so than the 10 years, increasing the yields for the 2-year more so than the 10-year. All that cash could potentially be obviously more valuable in the short term as asset valuations plunge. Now, remember that the Federal Reserve meeting is starting tomorrow, and so markets presumably are going to be a little bit light with purchasing power before the Fed meeting. Though remember, one of the lows that we had in March was March 8th and March 14th, literally a week and a day before the Federal Reserve meeting, and then we had a 3-week rally after the March meeting on the 15th. Yeah, it's a March. Hopefully, we can have something like that again, but then again, that might just be hopium. So I'm obviously still recommending cash, lots and lots of patience, no debt, and then buy as you feel comfortable quality companies that you know are going to survive a recession and a potential earnings recession, which Morgan Stanley and Goldman Sachs say we are not pricing in an earnings recession. We're just pricing in that Kevin's 50% off discount code on his programs on building your long-term wealth, especially with real estate, is the best deal he's ever had. So check that out in the link down below. But no, Morgan Stanley and Goldman Sachs are truly saying that we are potentially pricing in a recession, but not an earnings recession. This is really disastrous, and it follows the consumer sentiment miss on Friday, which was measured before we realized that inflation actually went up again so much, which actually means that consumer sentiment could extend lower before it goes back up. That's scary. Now, of course, you've got Stanley Druckenmiller, the Wharton professor. You've got Jeremy Siegel, the Wharton professor, suggesting now's the time to start deploying some of your cash because the deals are just so good. What are you doing? Are you buying the dip? Or is Morgan Stanley and Goldman Sachs potentially correct that an earnings recession could mean a lot more pain is ahead? Let me know what you think in the comments down below. And check out Public and the links on Building Your Wealth.